Imagine the United States trapped in a prolonged period of stagflation, a situation where high inflation persists simultaneously with stagnant economic growth and rising unemployment. This economic anomaly, once thought nearly impossible to sustain for long periods, poses complex and far-reaching consequences for the nation's economy, society, and global standing. To understand what might happen if the U.S. goes through stagflation for a long time, we must explore its causes, impacts, responses, and potential outcomes across multiple dimensions. Stagflation is a rare but dangerous economic condition that combines three daunting problems: inflation, sluggish or no growth, and high unemployment. Inflation means that the general price level of goods and services rises, eroding purchasing power and increasing the cost of living. Economic stagnation or low growth means that the economy's overall output either grows very slowly or even contracts. And high unemployment means that many people who want to work are unable to find jobs, leading to social distress and reduced income. These three elements together create a policy dilemma because measures that typically control inflation tend to worsen unemployment, and vice versa. If the United States enters a prolonged stagflationary period, it would likely begin with a shock that disrupts the delicate balance of the economy. Historically, stagflation episodes have been triggered by sudden spikes in the price of energy or commodities, supply chain disruptions, or misguided fiscal and monetary policies. In today's context, such triggers could be a surge in oil prices driven by geopolitical conflicts, a persistent supply chain breakdown due to global tensions or pandemics, or prolonged expansive fiscal spending combined with loose monetary policy. As inflation takes hold, consumers and businesses would face rising costs across the board, from food and housing to transportation and healthcare. This persistent inflation would gradually erode real wages, meaning that even if nominal incomes rise, the purchasing power of households would shrink. For middle-class and lower-income families, this can be devastating, as essential goods and services become more expensive while their income struggles to keep pace. Consumer confidence would decline and discretionary spending would contract, further slowing economic activity. At the same time, economic growth would stagnate or even decline, trapping businesses in a difficult environment. Companies would be forced to contend with rising input costs and uncertain demand, making it harder to plan investments or expand operations. Some firms might cut back production, lay off workers, or delay hiring, pushing unemployment higher. This increase in joblessness would compound social tensions and reduce overall demand, creating a vicious cycle that is difficult to break. The labor market would become particularly strained. As unemployment rises, job security diminishes, and wage growth stagnates or declines in real terms, many workers would find it challenging to maintain their living standards. Younger workers entering the job market might face bleak prospects, causing long-term scarring effects. Moreover, labor disputes could increase as employees push for higher wages to keep up with inflation, while employers resist due to tight margins. The government would be faced with an almost impossible policy balancing act. Traditionally, central banks like the Federal Reserve combat inflation by raising interest rates, making borrowing more expensive to cool demand and slow price increases. But higher interest rates also suppress economic growth and can lead to even higher unemployment. Conversely, stimulating growth by cutting rates or increasing government spending risks worsening inflation. The dilemma means that neither monetary nor fiscal policy can easily address stagflation without exacerbating another problem. The political ramifications of prolonged stagflation would be significant. Public frustration with economic hardship and uncertainty could erode trust in government institutions and leaders. Voters might demand radical solutions, shifting political power toward populist or extremist parties. Social unrest, protests, and strikes could become more common as inequality worsens and opportunities shrink. The polarization of society might deepen, undermining social cohesion and stability. From a business perspective, prolonged stagflation would alter investment and strategic decisions. Companies might prioritize cost-cutting, efficiency, and risk management over expansion and innovation. The environment of uncertainty could discourage entrepreneurship and new ventures, slowing technological progress and productivity gains. Investors would seek safe havens and assets that hedge against inflation, such as gold or real estate, while stock markets might experience volatility and subdued growth. Consumers would feel the pinch in their everyday lives. High inflation would make basic necessities more expensive, forcing families to cut back on non-essential spending, save less, and perhaps increase debt levels to maintain consumption. The middle class, often seen as the backbone of economic growth, could shrink as economic pressures push some into poverty or dependence on social assistance programs. Wealth disparities might widen, as those with assets that appreciate in inflationary times benefit disproportionately. Housing markets might see a mixed impact. On one hand, higher interest rates to combat inflation would raise mortgage costs, potentially cooling housing demand and prices. On the other hand, real assets like property often retain value better during inflation, making real estate attractive for investors. This dynamic could create affordability challenges for first-time buyers and renters, particularly in already expensive urban areas. The banking and financial sector would face unique challenges and opportunities during stagflation. Higher interest rates increase the cost of borrowing, but can improve banks' net interest margins. However, a stagnant economy with rising unemployment would increase loan defaults and reduce credit demand, impacting profitability. Financial institutions would need to carefully balance risk management with growth ambitions, possibly tightening lending standards. Trade and international relations would also be affected. A stagflationary U.S. economy might reduce imports due to lower demand, while persistent inflation could make American goods more expensive abroad, reducing exports. The resulting trade deficits or surpluses could shift, impacting global supply chains and currency valuations. Geopolitical rivals or partners may recalibrate their strategies in response to a weakened U.S. economy, potentially diminishing America's influence on the world stage. One of the most worrisome consequences of prolonged stagflation is its impact on innovation and long-term economic potential. When companies and consumers face economic uncertainty and financial constraints, investments in research, education, and new technologies tend to decline. This reduction in innovation can slow productivity growth, which is crucial for raising living standards over time. The U.S., long a leader in technological advancement, might lose its competitive edge to other emerging economies that manage to sustain growth and stability. On the social front, prolonged stagflation can exacerbate inequality and social stratification. Inflation disproportionately affects those with fixed incomes or limited bargaining power, such as retirees, low-wage workers, and the unemployed. These groups may face increased hardship, food insecurity, and housing instability. Meanwhile, wealthier individuals or corporations with inflation-protected assets may see their real wealth preserved or enhanced. This divergence can fuel resentment, political extremism, and social unrest. The strain on public services would also grow, with more people potentially reliant on government assistance programs, such as unemployment benefits, food stamps, and healthcare subsidies. Public budgets could come under significant pressure. At the same time, stagnant economic growth limits tax revenue, creating fiscal challenges. Governments might be forced to make difficult choices between austerity measures and expanding social safety nets. Education and workforce development would face particular challenges. As job markets shift and certain sectors decline, reskilling and upskilling become critical. However, budget constraints and economic uncertainty might limit public and private investment in education and training programs. This could leave many workers ill-prepared for evolving economic conditions, further entrenching unemployment and inequality. Environmental and energy policies could be impacted as well. The high cost of energy that often accompanies stagflation might accelerate interest in alternative energy sources and efficiency measures. However, economic hardship could also reduce funding and political will for ambitious climate initiatives, leading to mixed progress in environmental goals. Breaking out of a prolonged stagflation cycle requires bold and coordinated policy actions. One potential strategy is to target supply-side reforms that increase productivity, reduce bottlenecks, and lower production costs. Investing in infrastructure, technology, education, and innovation can help boost economic potential over time. Simultaneously, carefully designed monetary and fiscal policies must balance controlling inflation with supporting growth and employment. Some economists advocate for structural reforms to labor markets, tax systems, and regulatory frameworks to enhance flexibility and competitiveness. Others emphasize the importance of social policies that protect vulnerable populations while encouraging workforce participation. International cooperation is also vital, as global factors often influence inflation and growth prospects. The Federal Reserve would likely play a central role in managing stagflation. Its decisions on interest rates and monetary supply directly affect inflation and economic activity. However, during stagflation, the Fed faces competing pressures that can limit its effectiveness. Transparency, communication, and adaptability would be critical to maintaining credibility and managing expectations. Businesses and consumers can also take adaptive steps to navigate stagflation. Companies might focus on innovation, diversification, and operational efficiency to maintain competitiveness. Consumers might adjust spending habits, prioritize essential goods, and seek alternative income sources. Financial literacy and planning become even more important in uncertain times. Technological advancements could offer tools to mitigate stagflation's impact. Automation, artificial intelligence, and digital platforms can improve productivity and create new economic opportunities. However, these technologies may also disrupt labor markets and require complementary policies to support displaced workers. The international community would watch the U.S. stagflation closely. Given America's central role in the global economy, prolonged economic malaise could trigger ripple effects worldwide. Global supply chains, investment flows, currency markets, and geopolitical alignments might shift. Other countries could face economic slowdowns or benefit from shifts in competitiveness. In this context, global cooperation on trade, energy, climate change, and financial stability becomes increasingly important. International institutions like the IMF, World Bank, and G20 may need to coordinate policy responses and provide support to vulnerable economies. The human dimension of prolonged stagflation must not be overlooked. Economic hardship affects mental health, family stability, and community well-being. Stress, anxiety, and uncertainty can increase rates of depression, substance abuse, and social isolation. Governments, nonprofits, and communities must work together to provide support and resilience-building programs. Looking forward, the experience of stagflation could lead to significant changes in economic theory and policy frameworks. Lessons learned from managing this complex challenge might inspire new approaches to balancing growth, inflation, and employment goals. It could also spur innovations in data analytics, economic modeling, and crisis management. Ultimately, whether the United States can navigate a prolonged stagflation depends on a combination of sound policy, institutional strength, societal resilience, and international cooperation. While the challenges are daunting, history shows that economies can recover from difficult periods through adaptation and reform. In conclusion, a prolonged period of stagflation in the United States would profoundly affect the economy, society, and global relations. High inflation paired with stagnant growth and rising unemployment would strain households, businesses, and governments alike. Policymakers would face complex trade-offs, while social cohesion and innovation might suffer. Yet, through targeted reforms, investment in human capital and technology, and international collaboration, the nation could eventually break free from stagflation's grip and build a more resilient future. Thank you for joining this deep dive into the potential impacts of long-term stagflation in the U.S. If you found this insightful, please like, share, and subscribe for more detailed explorations of critical economic and societal issues.